Thank you very much, Matthias, and thank you everyone for coming today to listen to the equity story for the next, let's say, 20 minutes, 25 minutes. If you were to describe Finexity in one sentence of who we are and what we do, then we're a public listed infrastructure provider for tokenized capital markets. Now, the company was founded back in 2018, and right as of today, we run the most active trading venue for tokenized bonds in Europe. We've got two business units. We run a capital markets team that works just like any investment bank, where we enable issuers to structure, register, list, but also syndicate and distribute the various offerings. And then we run the infrastructure business that accumulates around 80 or 75% of our group revenue, or makes up for around 75% of our group revenue. And that's the infrastructure business that is called the exchange business. Now, my name is Paul. I've been the group's CEO since the end of 2018, predominantly running the capital markets team. And my deputy CEO, Michael, unfortunately can't be with us today. He's in another meeting with potential investors, as we're currently doing a capital increase that I will get to in a second later during the presentation. Now, when you think about our business model, we are really creating a new capital market. And a lot of you will be very familiar with the trading space and the way current securities are currently being traded and settled through conventional securitization processes and conventional tech infrastructure. Now, tokenization in itself of what we focus on, that what our infrastructure is based on, is just another way of securitizing regulated securities. So we're not really reinventing the wheel, we're just making it better. And when you look at the evolution of exchanges and trading venues, those have always been driven by technological advancements. Back in the days, stocks, bonds, funds used to be traded on the floor. Then Xetra implemented the first computer trading system. Now that changed the way stocks, bonds, as well as funds were being traded and settled. Why? Because in comparison to the floor trading, where there's no transparent order books, where settlement processes take a long time, computer trading changed that with centralized order books, market maker structures, and that obviously brought more liquidity to the market. Now, when you look at Finexity of what we are building now, imagine that you could trade any funds, stocks, or bonds that you currently have in your portfolio 24/7 with T+0 settlement. So you don't have to wait T+2, so 48 hours until the transaction is being settled at the minute. And we can make this work because we don't have any intermediaries that are part of the process, such as clearinghouses anymore on our infrastructure. So thereby we are creating a whole new world of how securities are being traded and settled through a regulated infrastructure. And of course, Finexity is not one of the only ones globally that is working on such an infrastructure. It is also other big players such as the New York Stock Exchange that has officially announced that they will be building a second exchange solely focused on the trading and settlement of tokenized securities. And that will all be done on chain, meaning that it will be settled on the blockchain. Now, the space that we operate in, and I remember 2019, I used to pitch the idea to some institutional investors, and they said, Paul, this will never happen. Now, when we speak to institutional investors in 2025 or now onwards in 2026, they will say, whatever you've said to us 5, 6 years ago has become true. And this is the way securities will be traded and settled in the future. But this has only become the truth and will be the standard for the future because we've had progressive regulation in our market, enabling us to now institutionalize our business even further, although we've already been able to institutionalize quite significantly over the last couple of years. But because of the regulation, it can now really be institutionalized to another level because the whole value chain from listing to trading to settlement is, including custody, is being regulated and thereby allowing institutional players to be part of it. Now, how does our business model work? Always remember that we have these two business units. We have your traditional capital markets team that you would also always find in any investment bank. So we engage issuers. Those could be corporate bond issuers, those could be real estate issuers, those could be infrastructure issuers. So it could be someone like Hausvorteil that just presented their company and the bond that they currently have in distribution. Now, we reach out to them or they reach out to us and they ask us, hey, we want to structure this new bond. How can you help us with from an advisory side, from a structuring side, but also maybe from a distribution side of things. So we look at it from a capital markets perspective and we tell the issuer yes or no, we can help you or we can't help you. And we have an in-house team that has worked in banks, that has the capital markets experience, that understands balance sheets, that really has the financial acumen to make decisions whether we want to support someone or not. Because obviously we cannot support someone if we don't believe in the business ourselves. Now, then if we support them, we structure the financial security for them. As of today, we've only been a bond marketplace. So we haven't touched funds and equity at all, but will do so in the near future, and I'll get to that later. Now, that bond that we've just structured is MiFID II compliant, meets all ISIN-based security structures, has all the legal documentation that is required in the European Union in order to issue, list, and tokenize a bond. And the OTC trading venue where we then list the bond has all institutional settlement models. Now, we have a bond on a primary market base that needs to be brokered to some clients because there's no need to structure something when there's no demand from the investor side of things. So what we do, and this really separates us from anyone in the market, is that we've been able to build a primary market distribution channel that allows issuers to effectively raise money within a couple of weeks. And we, for instance, done this, what I'm just telling you for Circus. So the AI robotics company, we've been their lead manager, we structured for them, we issued the bond, we listed it on the OTC platform, and then we reached out to a couple of investors, not directly. So we never speak to the end investor. From an infrastructure perspective, we only speak to the trading partners that are directly connected to our infrastructure and pitching them the bond, and then it's their decision of whether they then want to sell it on to their investors. Now, let's go back to the example of the Circus bond, because I think it shows you the distribution power and the strengths of our infrastructure quite well. We had a clear expectation that from the day we signed the contract until the bond had to be or like the issuance volume had to be completely funded, it was around 4 weeks. So we didn't really have much time because, I mean, again, structuring, preparing marketing documentation, but also making sure distribution is done, but also confirming to all consumer rights protection, which is usually 2 weeks until they can revoke their investment again. So it has to be fairly quickly. So from that perspective, we didn't really have time to speak to other trading partners. Other trading partners, I mean, we have the savings banks organization connected directly to our infrastructure. So they're providing order flow through all the different savings banks. We have an infrastructure component with the Volksbank, which also allows all Volksbank to then distribute potentially the Circus bond to their investors. So the infrastructure in the Volksbank and savings bank is being set, allowing us to drive order flow from then primary as well as secondary market base. Then we also have a number of wealth managers and investment brokers. In addition to further investment, our own securities trading firm, Effector, that we've taken over in September and just completing the ownership control procedures with them, that will bring another 45 tied agents behind that. Now, again, we had to be fairly quick, so I could only reach out to my own 2 brokerage companies that we run in the FINEXITY Group. In the FINEXITY Group, we have 2 different brands. We have the FINEXITY Invest brand, where we cater high net worth individuals. Average portfolio size 40,000, male, unfortunately male, with an average investment sum of around 10,000 per trade that they subscribe to. And it's around average age is around 50 years old. That's like the I would say normal investor that we cater on FINEXITY Invest. Next to that, we have another brokerage, direct investor in a brokerage brand that is Volks Invest. With Volks Invest, and there's also public information. It's a joint venture agreement that we have with the Egro Media Group, and the Egro Media Group is one of the largest media outlets in Germany. That allows us to spend around 20 million euros in retail marketing to win clients for the brand FolksInvest per year. So this is another big distribution channel, or will become a larger distribution channel for us in the future. So what we did with the Circus bond, we only took a small segment of our FINEXITY Invest clients where we know that they like listed companies, that they like sale-leaseback models, that they have this initial interest in coupons between 6 to 10% per year, and can also act quickly because of their liquidity. So we reached out to around 2% of our clients of FINEXITY Invest, spoke to them, they invested into the bond, and the bond was settled, and now it's just applied for secondary market trading and listing on the OTC platform, so further liquidity can be raised through that in the near future. Now, this is a traditional model of how we work. We get around, it's very important to notice that around 80% of the bonds that are listed on our OTC platform that you see here in the middle, we are not actively engaged in. So think about the example, for instance, of savings banks. Savings banks use us. They structure the bonds themselves. They list it on the OTC platform, and they distribute it to their own clients. So we just sit in the middle, and we make money on every single listing and trade that goes through our platform. And this is the beauty of the FINEXITY business model, that yes, we are running a capital markets team that is a profitable business unit for us, where we advise, we structure, we distribute, just like the Circus example, but this is not the core of our business. The core of our business is really sitting in the middle and allowing issuers from banks, from whoever they come through, our listing agents, to list their bonds on our platform and then take care of the distribution themselves through the various distribution partners that are directly connected to our infrastructure. Now, how do we make money? Because this is obviously a very important bit. As I previously mentioned, that FINEXITY is, in my opinion, the best of both worlds. We're running an infrastructure business that has the same fee structure that any exchange has out there. So we get admission to trading fees, tokenization fees, so securitization fees that you would usually pay to Clearstream. We get issuance fees, we have product maintenance fees, registry fees, to just make the OTC platform work. And again, through that infrastructure level, around 75% of our revenues are being generated. And then on the other hand, we've got the capital markets team that is just enabling deal flow on the platform and distribution power on the platform. And obviously that business can be very profitable because you're not very asset heavy. You're just advising companies, you're distributing different bonds to your own investor base. And as long as the bonds that you choose for your own investors work well, they'll be happy and they will continue to invest. Now, the capital markets team is complementing the exchange team, but the real focus of our business model is building the exchange platform further and further that will allow us to generate more revenue, but also turn the company into a very scalable business. I want to use the next five minutes to talk a bit about what really separates us from the market, because 99% of the players that have tried to exist in that exact market, in the tokenization space, have failed. And why is that? And why are we being successful? Number one, it's because they have built infrastructure, and they've probably built great infrastructure, to be honest, because there's lots of good tech companies out there, and infrastructure is always a means to an end in the end. And what I mean by this is that you can build the best infrastructure in the world, but if no one's using it, your infrastructure is worthless. And I think the capital, like the financial markets in general, are not very open to a lot of innovation. So if you go back in 2019, what I said, everyone told me this is not going to happen. Now in 2025, because we've built institutional track record with the savings banks, Volksbanks, wealth managers, corporates that are listed, non-listed entities. So now they're saying, okay, wow, if this works, then there is really something behind it and I want to be part of it. And regulation has really changed the game from that perspective. So what the other companies have done that have failed, they've just built the platform infrastructure from a tech perspective and said, everyone use it. No one's going to be your first client. So, and then there were other companies that said, okay, I'm going to build the infrastructure, and then I'm also going to show to the market that I can make it work. And what these companies did, they issued their own bonds, they distributed their own bonds, they built their own investor network, and this business model works. However, it only works up until a certain point. And that point is the point when you have the first few defaults on the products that you have sold to your investor base. So that traditional infrastructure plus brokerage model doesn't work. It only works the minute you have a certain independence of your own brokerage, because you want to really becoming the infrastructure player. You're just using the capital markets team to build deal flow, to do the distribution. But long-term wise, you just want to be sitting in the middle and make money whether markets go up or down, because you're living off the trades that are happening on your platform. Long-term secondary, but short-term to mid-term primary market distribution. And this is really what we've been able to do. Yes, we built our own infrastructure. We've invested millions into that infrastructure, but we have opened it. We've built an open infrastructure that can be used by third parties to list their bonds, to be part of the brokerage network, to drive order flow onto that brokerage network. So we sit in the middle and generate revenue at all times. And I think this is one of the key differentiators of the FINEXITY group, of what we've been able to do from an institutional perspective. Now, if you go further along the timeline, and the 5 key reasons that really separate us is that we've always said, focus on what you do best. Number one, we understand the bond business. We have become experts in the bond business. We have a massive track record in the bond business. Our platform infrastructure as of today is OTC. In our opinion, OTC infrastructures should not be really catering funds and equity. Why? Because they are more liquid than bonds. So we said, okay, look, there's no regulation in place, and that's 2020. There's no regulation in place for an MTF, which is a full-fledged kind of exchange setup plus a settlement system. So we said, let's focus on bonds, let's build the OTC platform, and we become an expert in that, and we become the most valuable player in that space. This is the track record that we have. Now, we'll be expanding this in the next years to to include funds as well as equities on our platform, because now we can drive liquidity through the various trading partners. That's number one. Number two, of what really separates us is that we have always built distribution. We've been a tech company, and we are a tech company with a distribution angle. So we never ever said we're going to be the strongest distribution company. We said we need to find the right institutional players that can drive order flow and liquidity onto our exchange. And this is what has worked, and that we've been able to build a technology-enabled primary market orchestration and digital distribution across various channels. Now, the third part is, and this is something now thinking about the next 5 years of where FINEXITY is going to be. Currently, we're running a bond OTC market. That's it. And of course, we have our capital markets team where we advise and we distribute, and that is fine. But we're currently OTC bonds. Now, in 5 years' time, we will not be running an OTC. We'll be running a pan-European MTF with settlement system in one license across the whole of Europe, thereby creating European order flow. On the second level, we will not be doing just bonds, but funds and equities as well. So this is the vision for the next 5 years, to make this work and build a pan-European exchange that allows the trading and settlement of tokenized securities. Of course, we're investing heavily in our infrastructure. So all the IP is owned by the holding company. It's all proprietary tech that we've built across the value chain. So we have the OTC trading venue. And some of you who have followed the company, we have recently released our AI strategy for the next 24 months that will allow us to drive more growth in terms of orders, but we do not increase OPEX at the same time, because we are currently rebuilding our infrastructure on a modular basis, which means that, for instance, we will have a separate model for the trading, for the settlement, for the KYC, and so on. Right now, it's a full-fledged package that we have, but the modularization will help us to scale much faster from a tech perspective. That's one thing. We have also built infrastructure that allows trading partners to be connected to the OTC trading venue. And I think that is really important, because no order flow provider or a broker really want to have the pain to spend months and years to be connected to your infrastructure. So you need to make it work from a very, very easy perspective. And this is what we've built through our white labeling offering. And then the third part is of where we've heavily invested now is our subscription box. And that is very similar to the subscription box that you may know from the Frankfurt Stock Exchange or the Stuttgart Stock Exchange, where the issuer can raise money through a subscription box that they implement on their website, so they can reach out to their clients directly as well. Now, and the fifth part that separates us is that we want to grow inorganically. We believe in M&A. We believe in the right M&A. We have proven that this is the case for in terms of two transactions at the minute, and we're currently prospectively exploring further acquisitions. However, our primary focus when we talk about acquisitions, we don't buy companies. We focus on asset deals. We focus on buying clients. We focus on buying brands that have a good reputation in the market because we can run them through our own securities trading firm in a regulated way on one infrastructure level that will reduce the OPEX and increase the EBITDA margins. Now, those are the 5 points that really separate us. Those are the accommodating slides, but I didn't want to scroll through this because I think it's important for you to really listen to me rather than looking at the slides. Now, to have a good company, you need to have notable and good shareholders as well, because obviously for us, we've just been listed in September 2025, and obviously with the market cap and everything, it's still a relatively small company with around 50 million euros market cap. But obviously we have a broader vision of everything that we are building and very good perspective in terms of the growth or the continued growth in the next couple of years. What is really important to notice is that we have a strong founder, management, shareholder alignment. So around 46.9% is owned by anchor investor, co-founders, management, and myself. 53.1% is owned by others. That's your typical free float. The executive board members, we've signed a 30-month lockup, and the other free float also has certain lockups over the next couple of months. That also explains why some of the liquidity on the stock can be sometimes low, some days are better than others, but in general, we are working on providing more liquidity to the market, and that will happen if we, for instance, do a capital increase just like we do now, so there'll be more stocks that can be traded. We have notable investors in our group, such as Suzanne. She's the current chair of the supervisory board of ING DiBa. We have Jan. He was one of the founders of AOL Europe, but is also one of the founders of Headline Ventures, which is one of the largest venture capital firms in the world with around 4 billion assets under management. And then we have Miriam, for instance, and she's the ex-CEO of the WM Group. They, for instance, are responsible they on the Börsenseite, but also they are responsible for the ISINs. We have a diverse group of investors, from institutional funds to family offices, business angels, strategic investors. And I think this is what really drives the growth of the company, is that we have the best of both worlds. We have people that understand the pain, and that's typically portfolio managers, fund managers that understand the pain of the current trading venues, the order depths, the liquidity, and see real potential in a new infrastructure that allows the trading and settlement of securities 24/7 at a fraction of the cost at a more efficient level. And on the other hand, we have investors that see the bigger pictures that say, okay, you're really enabling a new capital market to flourish at a lower cost ratio. When you look at our numbers, our pro forma group consolidated numbers for 2025, 8 million euros in revenue, predominantly driven through the exchange business unit infrastructure level, with a negative EBITDA of 2.7 million euros. In 2026 pro forma guidance, group consolidated 9.6 million expected, was predominantly revenue driven through the exchange business, with an EBITDA of minus 3.5 million euros. Now you might say, Paul, how come you are more EBITDA negative, like your EBITDA is worse than in 2025? The reason is we are investing. When you look at our depreciation schedule of the company, we don't really amortize any of our tech expenses, so our P&L is very similar to our cash flow, and we're heavily investing into our infrastructure. In Q1, to get a better feel for it, we are around 40% top line, so on revenue side above budget, 35% better than on EBITDA budget, obviously EBITDA negative. And the highest cost factor or OPEX factor is salaries, with around 750,000 per quarter across the group, around 30 employees. And the second biggest OPEX is regulatory work and tech expenses, where we're heavily investing. As a midterm guidance, very important to notice, the management board believes, and this has also been confirmed by certain analyst reports, that we believe that we can scale revenue to over 70 million euros as a midterm guidance in the next 3 to 5 years, with an EBITDA margin of 25 to 30%. How can that be derived? that can be derived with a 0.3% implied market share of tokenized securities expected in 2030 by McKinsey. So McKinsey is saying by 2030, you will have around 900 billion of tokenized securities in Europe. And for our business model to work, we would have to have 0.3% of the implied market share listed on our OTC platform. There's more depth in terms of our numbers. Now, the last 2 minutes or so, if you were considering investing today into FINEXITY and becoming part of the group. Now, there are 6 reasons you should take away today. Number 1, in comparison to all other players, we have a proven business model. We have a business unit that's profitable and that complements the scalability of the business, the exchange unit. That is a $1 trillion market opportunity. I believe that anyone is familiar with the tokenization space or in the conventional securitization space understands that this will change the way securities are being traded and settled in the future. And that's why it's a $1 trillion market opportunity. We want to grow inorganically. We have the M&A expertise. We have the people in-house to then also integrate those companies. We have that strong founder and shareholder alignment and a diverse management with a strong track record. Next to me, our Deputy CEO, who was 32 years at Deutsche Bank, has a vast network in the banking space and a great track record, also running, for instance, BRW Bausparkasse, which is the mortgage lender of Deutsche Bank, with a balance sheet of 55 billion euros, with an ESMA license. So he was the deputy CEO of that. So we have the right people on board in terms of the management to really make this work. Now, we're currently in a rights offering. We're currently doing a rights offering at a subscription price of 36 euros. We're raising up to 7.4 million euros. The use of proceeds, 4 million infrastructure regulatory. That is for the exchange business. Then the next 3.5 million euros will be 1.4 million euros net proceeds from the capital increase that we will need to invest into the purchase price of the securities trading firm, Effecta, that we've bought. Purchase price is 1.8 million euros. However, equity in the company is 400 to 500 euros, varies a bit. So the net purchase price around 1.4 plus 2 million euros in working capital. That will allow us to turn profitable up until 2028, with the break-even point reached in that year. Now, the capital increase subscription period will end this Friday, and then there will be a run placement. However, the public offering period, so you can already subscribe today. You can go on our website, finexitygroup.com, have a look at it. There is all information on the capital increase, the analyst coverage, and everything else that you would need to know about the capital increase. Thank you very much for your time.
Excellent presentation as always, and there's so much interesting stuff going on with FINEXITY. What excites me personally most is this digital subscription flow process where investors can subscribe tokenized or through conventional securities. How do you think this process could change the landscape for investors?
I believe that in any transition when you look at floor trading and computer trading, the same thing happened. Will both continue to exist in the future? Yes. Will conventional securities continue to exist in the future? Yes, because you cannot change the whole market at once. Will it take time to change it? Yes. So what we have built is that we try to combine the best of both worlds. What we do is that we say, look, if you are an issuer and you want to raise, let's say, a bond, 50 million euros as an example, we know that we can facilitate probably 10 to 15 of that through our infrastructure level with the trading partners, if we have time to really distribute it to their investors, without any institutional coverage. So this is just retail. Now you're left with a significant proportion of the bond that you want to raise. Now with that, yes, we can reach out to institutional investors, and that is fine as well. But we're also giving you the option to conventionally securitize. So your bond would be listed on the Frankfurt Stock Exchange, that would be listed on our OTC platform. So we would have 2 different listings with 2 different ISINs. So we believe that in the next couple of years, we will still be triggering the best of both worlds, and they will coexist. And now, and that's what I previously mentioned. I said, what's the buildup for FINEXITY? And I believe that in the next 5 years, when we sit here, and there will be another conference that I'll be speaking at, then Finexity will be running the leading pan-European exchange for tokenized securities. But we will have also triggered some issuances on the conventional securitization system. If we then sit here in 10 years' time, and some people say this will be far quicker than what I'm expecting, but I'm always on the conservative side of things. I believe that Finexity will be white labeling its infrastructure to third parties, to other exchanges, and we will be building centralized order books that will settle conventional securities with tokenized securities. So all the work that we're doing today is not that we are giving away market share to others. We are actually building an ecosystem that will allow us to, in the end, centralize order books, conventional securities with tokenized securities, build a second layer below it that will then, in the end, enable you with the trading of tokenized securities together with tokenized securities.
Excellent. We just hit the 12:30 mark. So, Paul, thank you so much.
Thank you very much.